Hello and welcome to AFM 451. In this video, we set the stage for understanding audit opinions and examine how internal control deficiencies influence the auditor's reporting decisions. Let's get started. An audit opinion is the formal conclusion issued by the auditor after evaluating whether the financial statements are presented fairly in accordance with the applicable accounting framework. It is not a commentary on business performance. It is a structured assessment of whether the financial reporting is free from material misstatement. There are four primary forms an opinion can take: qualified, unqualified, adverse, and disclaimer of opinion. Each reflects a different conclusion about the reliability of financial statements or the sufficiency of audit evidence. At this stage, the key takeaway is that the audit opinion is the conclusion of risk assessment, evidence gathering, and evaluation of material misstatements and control effectiveness. We'll go through each of these audit opinions in a subsequent video. For now, let's take an understanding of how internal controls affect reporting. Let's distinguish between the different levels of control deficiencies that ultimately feed into the audit opinion. A control deficiency exists when the design or operating effectiveness of a control does not allow management or employees to prevent, detect, or correct misstatements in a timely manner. For example, bank reconciliations may be performed monthly but not independently reviewed. In this case, errors could persist if the preparer overlooks these discrepancies. In another case, access rights to accounting system may not be updated when employees change roles. This creates unnecessary exposure. These weaknesses increase risk but may not rise to a level of broader concern. A significant deficiency is a bit more serious. It is less concerning than a material weakness, but significant enough to merit attention by senior management, audit committee, board of directors, etc. Consider a situation where revenue cutoff procedures are inconsistently applied at year-end. While no material misstatement has yet occurred, the process weakness increases the likelihood of one to happen in future. Another example could involve inadequate oversight of management's estimate of warranty provisions. The estimation model exists, but the assumptions are not periodically challenged, creating an elevated risk. Significant deficiencies must be communicated to audit committee or the board of directors, even regulators in some cases, and escalated even if the financial statements remain fairly stated. Lastly, we've got material weaknesses. These represent the most severe category of control deficiencies or findings. It exists when there is a reasonable possibility that a material misstatement will not be prevented or detected in a timely manner. For instance, if the company lacks segregation of duties in its cash disbursement process, and one individual can authorize, process, and reconcile payments, the risk of material fraud now becomes substantial. In another scenario, let's say if management overrides controls to accelerate revenue recognition, and those overrides are not independently reviewed, the control environment itself now is compromised. Imagine where there is a complete absence of review over complex fair value estimates. This leads to material misstatements in asset valuation. Material weaknesses directly threaten the reliability of financial reporting. When deficiencies are identified, auditors evaluate their severity and consider the potential impact on the audit opinion. In future discussions, we will connect these classifications to specific audit opinion types and understand how material weaknesses or scope limitations influence the audit outcomes. We, as auditors, must use professional judgment and apply standard procedures, but ultimately, these opinions rely on our expertise. It's about analyzing evidence within the context of what financial statements represent. Complex judgment calls require a solid understanding of both the business environment and the technical nature of the financial reporting. Every audit opinion carries weight built upon layers of evidence and seasoned professional judgment. By applying the logic based on nature of the business, severity, materiality, and pervasiveness, we can ensure that our conclusions are both sound and defensible. Thanks for following along. Take care, stay safe, and bye for now.